Hello everybody, my name is David, and if you have an interest in the stock market and are looking to get the most out of your share portfolio, or perhaps you're looking to start a new portfolio from scratch, then I'm about to share 4 key points that can significantly boost your returns and change the way you view investing. Key point number 1. I'll explain why being involved in the stock market can be a great opportunity for future income and growth prospects, and why now may be the best opportunity to get involved. Point number 2. I'll explain what mindset you need to develop when looking for opportunities. This is something I've picked up over the last 20 years as an active stock trader. What I have to share with you is something you've probably never heard before anywhere. Point number 3. I'll highlight some important factors you need to know when building a stock portfolio, like which stocks to look at and how to quickly value them. Finally, in our 4th point, I'll show you where the best opportunities are right now and how we can stand to profit from it. Then I'll show you which companies I like and have actually invested in. So why is being invested in stocks a great vehicle for future income and growth prospects? Well, it has a lot to do with inflation. You see, many countries in the developed world keep growing their money supply like it's going out of fashion. When we look at countries like the United States, Australia, and the Eurozone, they're all the same. So this, over time, keeps putting negative pressure on the value of those currencies in those jurisdictions. Let's demonstrate this by looking at the gold price over 5 years and see what conclusions we can draw from this. You can see here that the gold price per ounce in US dollars has gone from about 1200 to about 1800. That's an increase in the gold price of about 50%. Now compare that with this next chart, which looks at the increase in the US money supply for roughly the same period. You'll notice it's gone from 13 trillion to 21 trillion. That's also an increase of about 50%. So what does this tell us? It tells us that if we held our money in a bank account for the last 5 years, then our average annual return would have been negative 10% compared to having held gold for the same period. Interestingly enough, I compared it with silver as well, and it worked out to be exactly the same. Now, there are many things that can contribute to inflation, not just the increase in the money supply, but the overall consensus is that the purchasing power of our money will continue to deteriorate as it has over the last 50 years, but perhaps even accelerate going forward. So what does all this have to do with your investment of shares in a particular company? Well, a good company that provides needed value to its customers will continue to readjust its charge rate to keep its head at or above the inflation rate, future-proofing its value. Also, dividend yields can be adjusted accordingly to please shareholders. Ultimately, this protects both the value of your investment and your income going forward. Cash, on the other hand, just sits there deteriorating in value. What mindset can we develop to get the most out of our stock portfolio and actually enjoy the process? Well, it's simple, and that is that it is never a bad day on the stock market. Truly, it is never a bad day on the stock market. When the stock market's up and we have profit, that's a great thing. If the stock market is down and our portfolio is down or even at a loss, well, that's also a great buying opportunity. So let's take a look first of what actually happens in reality. Some stocks are high in our portfolio, some stocks are down. We can dollar cost average out of the profit portion of our stocks. We don't want to liquidate the stock completely because our objective is to grow our wealth, but we can sell the profit portion of that particular stock that's high, and we can move that towards a stock that is down, that's still of great value, and therefore balancing out our entire portfolio. Now, this is not a trigger-happy approach. Our objective is to trade the least amount possible. And we need to keep in mind the brokerage costs to do those transactions, as well as tax implications. But ultimately, it is never a bad day on the stock market. What's another reason that can help us to have that attitude that it is always a good day on the stock market? Well, it is because not all our wealth is simply just in the stock market. It's diversified across a number of different asset classes. And if you haven't seen my video on how to make money and grow it, I'll put a link in the description. It looks at where those asset classes are and how we can manage the diversity across those asset classes. The important thing to note is that when we buy stock in a company, we are ultimately taking part ownership of that company. We're convinced that over time that what that company has to offer will continue to be in demand. And despite day-to-day price fluctuations, we know that the economy will always be there. And even if the economy is in crisis, then we expect that at some point it will normalise. What are some important factors to consider when we're ready to pick a stock to add to our share portfolio? Well, we need to plan and we need to create some structure to ensure that our portfolio remains balanced over time. This means that we will break up our portfolio into two categories. The first category is those stocks that will be part of what we would consider primary importance. And then we'll create another category of stocks that we would consider of secondary importance. Now, 90% of our total portfolio's value will end up going in the 50 biggest companies in any given market, whilst only 10% of our total portfolio's value will be allowed to go in the top 200 biggest companies in any given market. And if any one of these companies drop out of their category, then we would simply liquidate them and replace them with suitable ones if there are any around. Be sure to diversify your positions into different market sectors too. For example, you may want to have stocks that have exposure to property, others that have exposure to commodities, technology, healthcare, and even some in cash, ready for that next opportunity. So why have we put so much emphasis on investing in the top 50 biggest companies in any given market? Well, these companies got to be there for a reason. They have the best strategies, the best people, the best resources, the best funding options available, and that gives us the best chance of success. Keep in mind that the share price of any company is not indicative of its value. Neither is the value of a company indicative of the share price. Hence, this is where the biggest opportunities lie. So how do we value companies? Well, it needn't be a long and drawn out process. When it comes down to the crux of it, it's just a few simple things that we need to keep in mind. And I'll put a link in the description below to give you access so that you too can look at this information that I'm about to share with you. Now, when it comes to valuing a company, the main areas I found to look at are its core business, its financials, its PE ratio, and whether the company is centered more on income or growth. So let's have a look at these one at a time. Now, when it comes to looking at a company's core business, decide how valuable what it supplies to the market will be compared to its competitors, and then estimate future demand for that value. When it comes to a company's financials, its total revenue is an important thing to look at. It looks at the total income that the company made from selling its goods and services. However, the cost of revenue is also important, as it looks at the total costs for delivering those goods and services that it sold to its customers. And if you minus the total revenue by the cost of revenue, then you end up with the gross profit that the company made, or the total profit. It's also worth noting though the net income, as this shows the clear profit after all costs were taken out, like taxes. When it comes to historical financials, it's worth noting these four matrices to determine possible future trends. Also, keep an eye on debt levels, as these may be an indication of the overall health of a company. And if you'd like to know more about a company's specifics, then just go to its webpage. Its homepage will normally tell you much about it. Also, annual reports are published, which can also give you much more insight into where the company is headed. The PE ratio of a company is also another important thing to look at. It's a measure of the price of a stock relative to its earnings per share. Now, if a share price of a company is $100 and it earned $10 per share that year, it has a PE ratio of 10. Now, PE ratios of less than 10 may be considered undervalued, whereas PE ratios of greater than 10 may be considered overvalued. It may be important for you to know whether the company you're interested in is income driven or growth driven. Companies usually focus on either providing income through dividends or growth potential, which is capital appreciation, or they actually sit somewhere in between. Define which end of the scale the company you're interested in actually sits. Companies with a history of providing dividends, let's say typically 6% or so, are usually income driven. Companies that pay little or no dividend are usually focusing on providing growth potential. This can change slowly over the years, so it's worth checking every now and again. That's it for valuing stocks in a nutshell. Once you get the hang of it, you can scan through a number of stocks in relatively short order. It's a good way to get an overall view of a company's position. Now, where do I think the best areas of opportunity are right now, and how can we profit from it? Well, the first place to look is in the mining sector. Let's have a look at this in a little bit more detail. Large diversified mining companies is also another place I'd like to be. Traditionally, they can be a great hedge against inflation too. Also, companies that have exposure to gold and silver. Now, while storing gold and silver securely in physical form has the least risk and is an absolute great hedge against inflation, holding shares in these companies and having exposure to them can yield significant upside. This is because a small change in the commodity price can have a significant impact on the company's profits and therefore the company's share price. Copper is also another great place to be. Any company that has exposure to that, I'm very bullish on. It's used extensively everywhere, whether it's electric motors, buildings, electronics, cookware, etc. It's everywhere. Rare earth minerals is another great place to be. There seems to be a growing demand for where these can be used. Check out this infographic and just see how diversified rare earth metals are these days. It's used in so many places. Also, REITs, real estate investment trusts, they also give people great exposure to things like shopping centres, residential property, office buildings, industrial property. They can provide a good way to get income and capital growth, and it further diversifies our portfolio. Also, telecommunication companies is another place I like to be in. More and more people seem to be conducting business online these days. Those providing products and services relating to the internet should continue. Now, based on what we've covered so far, here has been my favourite list of stocks that you can purchase in the United States. Now, in the first group there, you can see that most of them are common brands that we're quite familiar with. But it's that next group that has that exposure to those mining companies where I feel the greatest growth potential lies. Now, here is a list of my favourite Australian stocks to purchase, ones that I've held for some time but have recently topped up on. There's been a lot of talk about ETFs or exchange traded funds lately, and they can be a great vehicle to give us low cost exposure to a diversified portfolio of assets, or to give us low cost exposure to a specific asset class like gold or silver. But we need to check whether the ones that we have exposure to have exposure to derivatives, margin lending or other third parties, as this may add extra risk to our investment. Indeed, owning shares in companies can be a great way to preserve the value of our wealth and give us a great income stream. If we follow a measured and structured approach, then we can build a portfolio that can truly stand the test of time. If you've enjoyed this video, then hit the like button and subscribe for more content like this. Anyway, thanks so much for watching. Bye for now.